Welcome to this explainer. Look, if you've been glancing at the global exchange charts lately, you're probably scratching your head, right? Today, we're going behind closed doors to solve a massive anomaly that is literally unfolding right in front of us. We're going to uncover exactly why precious metals are plummeting right now, despite a really stormy global economy. We'll use pure logic and the exact timing of some recent financial events to reveal a very elegant mechanism currently at work. And trust me, it's one that major banks are in no rush to advertise.
Okay, so let's dive into this huge contradiction. By all the traditional rules of economics, gold should absolutely be skyrocketing. Inflation hasn't been fully defeated, and global geopolitics are, they're highly unstable, to put it mildly. In conditions like these, the ultimate protective asset should be growing, or at least holding its ground, but instead, it's plunging, and it's dragging silver, platinum, and palladium right down with it. Now, a lot of folks just write this off as retail investor panic or maybe a strengthening dollar, but basic logic tells us this isn't just everyday retail investors panicking. To figure out what's actually going on, we have to look behind the curtain of the global banking system. And don't worry, we're going to do this without any of that complicated Wall Street jargon.
To solve this mystery, we first need to understand what we can call the banking financial airbag. See, any bank operates on a super simple premise. It takes money from depositors and issues it out as commercial loans. But to make sure a bank doesn't just go belly up during a crisis, international regulators enforce a really strict rule known as a reserve requirement. Think of it literally as a mandatory financial airbag. It forces banks to keep a chunk of their money, say $10 for every 100 deposited, locked away in the safest assets possible. They have to keep this on hand so if there's a panic, they can simply hand the cash back to the people. To see how this all builds up, let's look back for a second. After the massive crash of 2008, regulators introduced these incredibly strict new safety rules for banks, known as the Basel III standard. This completely changed how banks managed their risk, but here's the crucial detail for our mystery, and it happened much more recently. Between 2019 and 2023, a vital little nuance was added to these rules. Physical gold was officially upgraded. It was given the exact same Tier 1 status as actual cash and government bonds. For the banks, this was an absolute gift from above. And this brilliantly illustrates why banks suddenly started acting like dragons hoarding treasure. Think about the options they had. They could hold their mandatory safety cushion in boring paper dollars, which, let's face it, are slowly being eaten away by inflation. Or they could hold it in physical gold. Gold protects against inflation, it historically grows in value, it instantly makes a bank's balance sheet look fantastic, and best of all, it keeps the regulators perfectly happy. So naturally, banks just began vacuuming up the market. They bought tons of the metal, which of course inflated its price over the last few years. Fast forward to today. The U.S. economy was facing rising inflation, so the Federal Reserve, the U.S. central bank, stepped in to fight it. Their main weapon? High interest rates. Now, usually we're told this just makes loans more expensive so people spend less. But behind the scenes, this created a massive high-rate trap for the banks. High rates automatically mean expensive dollars, and this absolutely choked the banking system's liquidity, the free, live cash they actually need to operate day to day. The banks started suffocating in this tight grip, literally to the point where some regional banks actually failed.
This put the Fed in an incredibly difficult position. They found themselves totally trapped in an impossible dilemma. On one hand, they couldn't just cut rates to help the banks, because if they did, inflation would spiral right out of control again. But on the other hand, if they decided to keep rates high to fight that inflation, they'd have to just sit there and watch the banking sector continue to suffocate under this immense financial pressure. They desperately needed a way out.
So, here is the crucial point, how the regulator played a brilliant double game. They went with the old principle, punish with one hand, pardon with the other. For the public, the Fed kept up this tough, strict face, declaring that rates were absolutely going to remain high to fight inflation. But behind the scenes this spring, they quietly threw a massive regulatory lifeline to Wall Street. They released this sweeping document that was essentially aimed at saving the banks without ever touching those public interest rates.
The secret fix proposed in that document was surprisingly simple, actually. The Fed quietly went to the biggest banks and basically said, "Look, we know you're struggling, so we're going to let you hold a smaller safety cushion." They proposed dropping the mandatory reserve requirement, so where a bank previously had to freeze $10, they would now only be required to freeze $8.
By simply tweaking that mathematical requirement, the Fed essentially allowed banks to shrink their mandatory financial airbag. The banks could then take that difference and immediately put it back to work. And guys, this wasn't just some minor adjustment.
This quiet rule change instantly frees up hundreds of billions of dollars in liquidity for the banking system to use in the real economy. That is a massive, massive amount of capital suddenly unlocked.
Okay, so how did this smart money actually play this out? Well, whenever the Fed makes an offer like this, there's a mandatory 90-day public comment period before they can finalize the rule. So the banks simply had to wait and see if this unprecedented generosity would actually get approved. Right around late June, that 90-day period expired. No one blocked the project. The bankers got their final green light that reserves could officially be lowered. And the exact second that happened, pure cold-blooded capitalism kicked in and the quiet sell-off began.
Put yourself in the shoes of a major bank director looking at this cold capitalist logic. You no longer need giant gold reserves to satisfy the regulators, plus your gold has skyrocketed in price, hiding these massive paper profits since you bought it way cheaper. But gold itself is a 0% dead asset. It just sits there in a safe. It doesn't pay dividends. It doesn't pay coupons. So what do? You sell the gold at peak prices, you lock in those record profits, and you take those newly freed billions of live cash to issue commercial loans. With the Fed's rates currently so high, those loans bring the bank a massive 5 to 7% annual return. Sitting on gold in these conditions, it just makes no sense.
But wait a minute, you might be wondering, the 90 days have passed, sure, but the whole bureaucratic machine means the actual law won't formally take effect for months, maybe not until autumn or even next year. So why is this massive dump happening right now? Well, this is the key detail that really explains how high finance truly operates.
The answer is that institutional money operates on inevitability and scale. Wall Street always lives in the future. The biggest players, the smart money, they never wait for the official piece of paper with a stamp on it. Once those 90 days expired, the rules shifted from maybe to inevitable. And because of the sheer math involved, a major bank can't just sell billions of dollars of gold in a single day without completely destroying the market and their own profits. To lock in their gains at the absolute peak, they have to execute a slow, calculated rebalancing. They unload their assets day by day, week by week, getting ahead of the curve way before the rules are official and everyone else starts selling.
Ultimately, this proves that what looks like random market panic on the charts is absolutely nothing of the sort. It's a highly orchestrated, cold-blooded rebalancing of massive banking portfolios. The banks are simply extracting their wealth from gold bars and moving it into high-yielding dollar cash, taking full advantage of the regulator removing that noose of strict reserves. As our source perfectly puts it, gold performed its function as a life ring in hard times. Now the system elegantly puts it under the knife for fresh liquidity.
I'm going to leave you with this final, provocative thought to ponder as you look at the markets tomorrow. We've just seen how the smartest players operate months in advance of official changes to absolutely maximize their returns. If smart money is already extracting billions based on future rules, setting up their next big play, what asset are they quietly hoarding right now while everyone else is distracted by falling gold? Think about that for a bit. And hey, thank you so much for joining me on this explainer. See you next time.